Hello, everyone. My name is Kent Fisher, and I'm a partner in the Laguna Hills, California office of Eide Bailly, and I do specialize in certified audits of mainly California-based banks, including one large SEC filer. Erin's going to be kind of joining me today, doing some color commentary. So, Erin, do you want to quickly introduce yourself real quick?
Sure. Hi, guys. My name is Erin Villafana. I am a senior manager also in the Laguna Hills, California office. And I, as well as Kent, we specialize in banks ranging from 200 million in asset size all the way up to almost 7 billion in asset size. So excited to be here today.
Very good. So Erin and I, as well as Bettina Brown, who's going to be doing the tax update portion of this, have been working together the past, I'd say 13 years as a team, serving, California-based banks. So we're going to be spending about 45 minutes here on the accounting and regulatory developments section, and then the tax section will get another 45 minutes. So that's how we split it up, and we'll go first. You can see here the agenda that we put together today. Of course, it mainly covers the CARES Act and the COVID-19 pandemic, and as well as some other items that we've thrown in that have just percolated up in our daily assisting clients. And so we're going to go ahead and start by looking at, first of all, the Eide Bailly footprint. This is somewhat pertinent because we're going to be covering some statistics before we get into the technical discussion. And Eide Bailly is basically a west of the Mississippi firm, as it's kind of commonly referred to, at least internally. It's a large firm, top 25 firm. There's probably 800 banks that we do in this region. There's more than that total, but most of the audience here, I think, would be coming from this west of the Mississippi footprint that Eide Bailly serves. And I just wanted to highlight that because it's pertinent to some of the stats that we're going to be looking at here, starting with this one, although this is more of a whole industry chart, and this is as of June 30. And it just highlights the fact that the allowance for loan loss the dollars in the allowance for loan loss have almost doubled since the end of 2019. Now, of course, this is the entire industry. It's mainly the large banks that are driving this, because that would reflect a 100% increase in the allowance. And certainly our banks haven't seen that sort of increase. And so, and I think it's amplified also by the fact that the large banks have adopted CECL as of 1/1/2020. So this chart isn't real helpful to, I think, the audience here. We did slice and dice the data a little bit differently here, so it was more meaningful for this audience. So this is all banks under 10 billion in assets, west of the Mississippi, and this is showing this is again in dollars, and this shows about a 25% increase in the allowance dollars since the end of the year. And so that's a little bit more reflective, I think, of what our clients are seeing in the way of increase. Just to break that down a little bit differently, this is the allowance for loan loss to loans through the June 30 again, and this is for that same group of less than 10 billion west of the Mississippi. And you can see here that the PPP loans sort of get in the way of the actual number here. So when adjusted for the PPP loans, this is showing a average of 1.61%, 1.45 before adjustment, 1.61 after. And then we looked at the median too, and you can see that highlighted in yellow. That's at 1.29 at 6/30. With PPP adjusted at 1.41. And that's, I highlighted that from the standpoint that that's kind of what I'm seeing for my clients, is that they were probably generally, if they were right down the middle of the fairway, 1.25 perhaps, and a peer group would be about the same. And that's ticked up, for sure, by increasing the Q factors. Obviously, this is all in expectation of increased credit risk, not the actual realization yet. I think that'll come later. But that reflects about a 10% increase. And so if we had to sort of, as of June 30, sort of a ballpark it, I would say there's been probably anywhere from a 10 to 25% increase in the banks in our region, the west of Mississippi region, in anticipation of increased credit risk. The loan deferrals, this is a chart from S&P Global that I pulled. And I guess at the height of the activity, there was about a 10%, and I think this is industry-wide. There's a 10% of the industry loans were in a payroll, or I'm not sorry, in a payroll, but a deferred payment position. Now, as has been commentated, and it's pretty much known at this point, that dropped significantly, by the end of the summer, which is reflected here. It's the light blue bar line there. It went from 10% to 5%. Yeah, and I think there's pretty good anecdotal evidence that it's much lower than that now. In fact, I just finished up the 10Q for my large SEC filer, and they had a 97% reduction in their deferred payment loans, and that's a pretty amazing statistic. And it's I guess the resiliency of the United States industry, I guess, and the borrowers out there is pretty remarkable. And so that's reflected here in this S&P. They do a projection occasionally, and I think this one's as of October, I think 9th. And they had an earlier projection in July when they wasn't quite sure, whether these payment deferrals, would they manifest in non-accrual loans, which is the, I guess that's the top chart, and then the bottom chart is charge-offs. And so the original line peaked earlier, from the July projection, but in the October projection, once it was apparent that the loan deferrals were in better shape and starting to reduce, they delayed the amount of the non-accruals and the charge-offs. And so this is just sort of a projection. This is what a S&P Global thinks where we'll see the peak of the realization of the expectation of credit risk. It looks like it's going to be, they think, in at least at this point, mid-2021. So 2021 could be a difficult year when it comes to just dealing with non-accruals and charge-offs, and that's kind of what we're anticipating. And then finally, we've got a projection here from S&P Global that we kind of sorted out and just reduced it to all community banks in the country, less than 10 billion in assets. And just wanted to put this up there to sort of, it's a bit of a sobering projection here in the sense that you can see 2019 actual, and then you've got 2020 through 2024 projected. It's going to be a long slog to get back to, the 2019 normal. You can see it just 2020 isn't too bad when it comes to profitability. I think that's probably because of triple P income. 2021 looks pretty bad, and hopefully it's not as bad as that looks there, but I guess that's maybe consistent with the expectation on charge-offs and non-accruals, perhaps. That interest margin, there's basically two tails here, of the overall themes, and that is the expectation of increased credit risk, as well as the NIM compression. And those two things are just going to drive everything when it comes to profitability. So, okay, so that was just sort of the backdrop for some of these technical discussions that we're going to start getting into. And maybe before I do that, Aaron, I think you and I talked about that all those stats are as of 6:30, and you and I have worked on some 10Qs, and so we have a little bit of a feel for the 9:30 information, and what have we seen at 9:30 just to augment what we've looked at there for June 30.
It's like the regulators said in their panel this morning, it's sort of a wait and see type of environment that we have. Really no issues with credit quality at this point, but primarily due to all of those stimulus packages and whatnot. So we're really not seeing a whole lot of deterioration at this point, but it's one of those wait and see things. Okay.
Yeah, I think I've maybe had a few phone calls from maybe one or two clients who have had some loans emerge from the payment deferral process, and they just don't have any, they don't expect to collect all the principal and interest on those loans, and so they have moved them to non-accrual. So I think in the fourth quarter, I think we'll start that ramp on the non-accruals. I'm not sure that we'll see so much on the charge-offs. I think that'll be delayed, but I think we'll start to see that on the non-accruals. But again, not too much evidence at 9:30. The profitability levels are down because of net interest margin, but and because of the increased provisions. But generally speaking, it looks like the banks are gonna have a pretty good year for 2020, decent year compared to 2019. All right, so let's get into some of the accounting and regulatory discussions here, starting off with triple P processing fees. This is almost an old topic. It's kind of stale in the sense that most people have chosen their method that they're going to use and are going with it. And most, I think, chose the default method because that's the default method. It's the easiest one. You simply load in the information into your loan system, and you let it calculate the interest income over the contractual life, and then there'll be a windfall at the end once forgiveness occurs. And so I would say in my client base, probably 90% of my clients went with that approach. Some of the larger banks, more sophisticated banks, wanted the smoother income, wanted to accelerate that income and recognize it earlier. And so they chose this alternative method, which you have to qualify for. You can't just elect it. there has to be an expectation that prepayments can be reasonably estimated. And so there has been a little bit of doubt, I guess, in the industry. We know of at least one accounting firm that has thrown a little shade on this, in the sense they don't necessarily believe that it's appropriate to use the alternative method. But I think if you develop a memo, that states your reasons, which is what my two clients have done, we think that it's something that can be justified, and we haven't had a problem with it. But just realize that there is some notion out there that it may not be just a simple slam dunk that you can justify this method. Some additional considerations on PPP loans. The pool method is a complex estimate, and that's going to be difficult for us to audit if it does carry over into 12/31, which we expect that it will. The adjustments have to be retroactive, and so that's a little bit of a tricky calculation. So just be aware that if you're on the pool method, that's a pretty complex calculation, and we'll be approaching it from an audit perspective as a significant management estimate, because some of the dollars are pretty large and can swing income pretty largely if you don't adjust it properly. PPP loan costs, I would say on average, if I had to ballpark, it would probably be about $500 per loan. That's much lower than what we saw or would see for normal, I guess, CRE and C&I type loans. I know that California, I used to do banks in Illinois for a long time, and nobody capitalized loan costs. It just wasn't material. Here in California, everybody capitalizes loan costs. I know that east of California, it's not as popular, and it's usually not material. So we do acknowledge that PPP loan costs in many cases probably weren't capitalized. They were relatively small. I had one client sell about maybe 3/4 of their PPP loans. They were looking to pad their 930 capital because they were a little short, and so there is a market out there for PPP loans. It does convert the income from interest income to non-interest income, but I doubt that that's happening very frequently out there. There's this notion here that you derecognize PPP loan and interest when cash is received, not when the SBA approves forgiveness, and that's kind of a common sense thing. But the reason that's an item is that when the initial guidance came out, it was the reverse of that. So hold on to those and keep them on your system until you get the cash. There's this PPP lending facility available, which I think everybody is aware of. And it was interesting that the Fed Reserve person that just spoke indicated there was about a 20% utilization on that, which is kind of consistent with what we've seen. Most banks have not gone all the way, haven't needed to use that to fund 100% of their loans. So now we're getting into payment deferral loan modifications. And there's a variety of modifications that we've seen applied here. The big takeaway is that no one went outside of their loan accounting. So that means that no one turned off the accrued interest contractually when they made these agreements and these modifications with their loan customers. And so that makes sense. I mean, no one wanted to go off of their loan accounting to attract this, right? So there's no manual accounting. It's all on the system, and it really doesn't matter how you handle the modifications. Really, there's a variety of approaches that we've seen, and as long as they keep the interest on contractually, then it's just putting it on the system and let the system calculating it. We have seen some pretty good sized accrued interest amount on especially some of our larger banks, and so they have, at least in one case that I can think of, gone out of their way to include accrued interest in their allowance for loan loss calculation. Most banks are not doing that. I copied here in the glossary discussion of what to do when you have a non-accrual, when you put a loan on non-accrual status, and how you handle the accrued interest, and how do you account for it? What do you reverse the accrued interest against? And normally you would just reduce it against interest income. If you do set it up in your allowance for loan loss, I guess there's this opportunity where you would reverse the interest that you charge off that was accrued in a prior year. You could reverse that against the allowance for loan loss. I think anything accrued in the current year would go against current year interest. So that's a little bit of a nuance that I don't expect a lot of banks to take advantage of, because it's not that significant. And most people, it's small enough to where it's not really worth including in the allowance for loan loss. And that probably continues to be the case. I did want to throw this slide in here that there was some noise about from the ICPA. They issued a technical Q&A that discussed how do you handle a situation where you did turn off the accrued interest contractually, but I don't think anybody did that. So I'm just acknowledging that exists, but it just created a little bit of noise and some maybe unnecessary confusion. Okay, so here we are with this interagency guidance and the CARES Act. So these were two competing almost sources of relief. And the first one is almost I don't know, it's a bit superfluous as it turns out, because I mean, it just clarifies existing gap. They provide guidance, but the real, what everybody's going to be using, I think, is the CARES Act Section 4013, because it just basically suspends TDR classification under existing gap. That's pretty huge, and it's a safe harbor. It's pretty complete. And so I believe, all of my clients are going to be invoking Section 4013. It is an elective accounting policy disclosure type thing. And the interagency guidance is just sort of, nice to have available, but I think where all the action is under the 4013. So that provides relief to our banks, so they don't have to go into the TDR classification. They don't have to deal with the cash flow, discounted cash flow approach. Here's the contrast between the two again. You have to qualify. They can't have been past due 30 days as of 12/31/19. I don't think there's many of those types of loans out there. There's no limit to the deferral period. The modifications can be made basically through the end of the year. Everybody's expecting that the emergency isn't going to be terminated. So that the earlier date will be 12/31/20. So we have through the end of the year. Now, as I think about that, I think once we get past that date, I think there is going to be a lot of TDRs in 2021. So, I mean, we'll have to dust off our old TDR hats. I guess, I know back in the day I was known as Mr. TDR. So I guess I'll be maybe reprising that role perhaps, which is, a little unfortunate, but anyway, so we do expect another round of TDR accounting starting in 2021. If you had interest rate reductions as part of your modifications, if you did them short term, then I think the regulators would see that as being appropriate under 4013. But if you did a long-term rate reduction that would extend beyond the impact of the pandemic, then I don't think that they would allow that to be classified not as a TDR, basically. So just be aware that if you're doing long-term, it's not a loophole. Basically, you can't go long-term on your modifications. So this kind of covers some of the things we've already talked about, where we basically avoided the discounted cash flow analysis with the invocation of Section 4013. What it doesn't provide is there isn't relief on other asset quality metrics, such as classification, non-accrual status, and allowance impact. Certainly the subsidies have delayed a lot of the problem loan emergence, the increased allowance for loan loss in the first 2 quarters. And again, the third quarter, I think the third quarter, we did notice that the provisions were down a little bit. So I think people were seeing that the things were being handled pretty well. So I don't think they ramped it up additionally too much in the third quarter. That was more so when we didn't know for sure in the first and second quarters. And so, but we have seen an increase, and mainly due to the Q factors. And I know I was partaking in another conference yesterday, and I think somebody was questioning whether or not the audit firms would how far would the audit firms allow banks to increase their Q factors? And I would say that we have a pretty wide fairway in that regard. Certainly the regulators, and I don't think we're going to be too resistant to a fairly aggressive use of Q factors. If you feel like you need to throw in more there, I don't, see us getting in the way of that, because it's such a subjective, determination. I think maybe if you're an SEC filer, you got to have some pretty good reasons as to what you're doing. But for non-SEC filers, I think that fairway is pretty wide. We do expect, like I've said before, that in the fourth quarter that we're going to start to see some downgrades and non-accrual incidents. And, it isn't going to be the past due 90-day type thing, because, contractually, they're probably not going to be past due 90 days. But when they emerge from the deferment period, and if they look around and there's no cash flow to serve the debt, then you're going to look to that core non-accrual definition to place it on non-accrual before it goes 90 days past due. And so I think that's where you're going to see a lot of non-accrual status is, you just realize that this borrower does not have the ability to repay the loan in accordance with the contractual terms, all the principal and interest. And so that's what we're expecting here starting this quarter, I guess.
Hey, Kent, we have a question. Do you want to answer the Q&As while we go through, or do you want to wait till the end?
You can do that.
So we have a question that was asked. It says, when does SBA PPP accrual stop? Do we get paid up to date of payoff? Up to date payoff is sent to the bank.
I don't know the answer to that question. I mean, it's obviously just a lag perhaps on the timing of the payment. So it isn't going to be a material difference. And so I just don't know how that's going to work. It's really not much different than any other type of loan, I guess, so that, when you receive payment, there may be a little bit of a lag there effect. I'm just not sure. So don't really know, but I don't think it's going to be material. All right. So just wanted to throw up here the call reporting on the 4013. I don't think that's publicly available information, but it is something that the regulators have requested and are tracking. So just be aware of that. All right, so now we're getting into some other areas, impact of COVID-19, and certainly with lower interest rates, there's a couple things that we're seeing, and just wanted to highlight for you the servicing assets. If you haven't 1 to 4 family or perhaps SBA servicing assets, prepayment speeds are sort of all over the place at this point, with I think 1 to 4 family certainly accelerated, which is going to diminish the value of those 1 to 4 family servicing assets. The reverse is true on SBA servicing assets because they've got that 6-month payment subsidy. And so those prepayment speeds have slowed, temporarily. I think probably they will pick back up next year. And so if you're close to having impairment, that could be a bit of a challenge for SBA servicing assets, because we do think that this extended low interest rate environment is going to prompt prepayments. If you've adopted this ASC 842, which is the new lease liability where you record your asset and liability, with the old ASC being 840, the incremental borrowing rate is going to be lower, no doubt. That's going to increase your right of use asset. That would apply, of course, to new leases and any extended leases. But if you've got, just regular, if you're continuing leases, you don't have to go in and adjust for those lower interest rates. It's only when you meet a new lease, or if you have an extended lease, then you have to go in and change that incremental borrowing rate, which is going to be lower. Some other areas, or another area affected by low interest rates, is salary continuation plan liabilities. I know a lot of banks have these things. GAAP does require that it has to be a reasonable discount rate, and it has to be reevaluated each measurement date. So a lot of times you get those schedules from the BOLI providers, and you kind of view them as being in stone, I guess. I mean, I don't think a lot of people think about the fact that there is a GAAP requirement here to track that rate lower if the definition of a discount rate here. You can see it here. It's pulled this from that interagency guidance that was dated back in 2004, still pertains. You theoretically should be adjusting the pace of your accrual, basically, and so there would be an acceleration of expense if you dropped your rate from, say, 5 or 6% to the say 3%, which we have seen. I just talked to a bank a few weeks ago that was going to drop their rate from 5 to 3%. Based on time consulting with their BOLI, accounting provider. So we don't see the regulators getting into this too much, but they do have a policy out there. It's something that can kind of surprise you. And so if you're not thinking about this, you may want to dust off your SERP accrual and see what rates you've got in there. And if it's 5% or above, you may want to have your provider rerun your schedules to see what the impact is and make sure it's not material. Goodwill impairment. We have seen some large write-downs, especially for public companies. Of course, those are a little bit more visible. But if you've got, and a lot of it depends on how big your goodwill is a part of your capital. And so I think any bank that's in the 40, 50, 60% of their capital in goodwill, which we've seen some of those, they've had to charge off, they've had to impair their goodwill, probably starting in the first quarter. And so those are a little more visible. But I think, non-public banks certainly have some goodwill out there. Theoretically, you do this, the rules for goodwill impairment, you would do this once a year, theoretically, and typically it's near the end of the year. With the March 13th or 14th, whenever the pandemic started, the March 31st would have been the first triggering event. And so all of our public companies have been assessing their goodwill for each of the quarters, starting with the first quarter of 2020. I don't know if our non-public banks are as good about developing, a triggered assessment. Probably not, but if you haven't done this, if maybe the regulators might be expecting to see something, or maybe your accounting firm, but we'd recommend, if you haven't done this yet, that you dust off your annual memo and update it for maybe a triggering event, which I think has occurred here. There's no doubt about that. Now, public companies, they cite a lot of times the drop in their price, which is significant, but I think you can just look at the activity, the merger and acquisition activity, and the prices that are reflected are down. And so I think that's a triggering event as well, I think, for pretty much any bank. So for the fair value estimates, I mean, it's certainly challenging because everybody went into a pause mode. We weren't sure what the impact of the pandemic was going to be. So we didn't know how do you value, what's a bank worth when there's no activity. post-pandemic, or there's very little. My one SEC client used a multiple of earnings based on prior multiple of earnings, but applied it to a projected level of earnings, which I think was a good way to build in the impact of COVID, using a multiple that was available. And so mixing and matching an approach that made sense. Did want to highlight here that there is an ASU out here in Goodwill that tried to simplify the impairment process. You know, step 0, for some reason they started with 0 instead of 1. Step 0 is to look at it qualitatively. Step 1 is then to kind of do a ballpark estimate based on the carrying value of the assets compared to the fair value. And step 2 would have been actually almost like a full acquisition accounting approach to determine what the impairment would be. But you can drop that step 2 if you adopt this 2017-4. So if you do get into an impairment position, I would imagine most people would adopt this, or you could adopt early if you aren't a SAC filer that's not an SRC, which is a smaller reporting company. I'm going to get into just some stats here just for goodwill impairment. This is just something I pulled from S&P Global that shows where deals have been announced in 2020. So that's it's just a kind of an interesting depiction of where activity is. Pulled another graph here, which does show you can see here what 81 deals compared to 257. We're not done with the year yet, but I mean, there is reduced activity, almost none in the second quarter. There is a precipitous drop in the multiple of book that's shown here, somewhere in the 100 to 120 range, which is the reason that we're going to have some goodwill impairments, because that's pretty low compared to where it was. And here's another one I pulled, 31 deals announced in the third quarter. So there is now starting to emerge some deals, but the multiple of the median here is 110. And as sort of a side comment here, I extracted something here from KBW, where it says that eventually, longer term, there's going to be, because of the NIM compression, there's going to be deals to deal with that. I mean, there's going to be acquisition. M&A is going to be the solution to this expected extended term of NIM compression that we're going to have in the industry. So be looking maybe for some more deals, maybe merger of equals. We're seeing that. Okay, on to CBLR relief and some other FILs that came out here. The CBLR is fairly new. I think the first quarter was the first quarter you could adopt it. And, the regulators came out initially with a 9% rate. Section 4012, the CARES Act did reduce that to 8% for the remainder of 2020, and then it ramps back up over 2021 and 2022. And there's, some grace period rules there too that you can see. So I did include this graph here with the blue and the dark blue representing those that opted in as of June 30. And the left side brown, as I'm looking at it, is the non-opt-in. And so a lot of banks looked at the CBLR and just said, we've got the processes in place to do the RCR Part 2, and they decided not to opt in. And so, it's been a bit of a dud, I think, compared to maybe what the regulators would have expected. Because really all it did is just reduce your time in performing the RCR Part 2. And I will say that when I talk to banks about it, it seemed like a lot of banks are getting criticized for filing improper call reports. And so, and a lot of the exceptions were in the RCR Part 2. They would mess up something relative to the risk-based capital, the denominator in the risk-based capital ratios. There was something on the risk-weighted assets that they would mess up. And so it does reduce that risk. I mean, if you do think you've got problems in accurate call report reporting, and your regulators have their crosshairs on you for that, then this might avoid a problem. We'll see how it develops. It's still early on the CBLR, but that's where it stands currently. A couple other less significant and less pertinent FILs, the conservation buffer, eligible retained income definition, was changed to lessen the impact, but I don't know of anybody that's in the conservation buffer or approaching it even. And then if you adopted CECL, if you were a large bank and you adopted CECL, you could take advantage of some additional, like a 2-year scaling method, which is fairly complicated, so I'm not going to get into it. I don't think it pertains to many banks here. And so there is a 3-year transition that's available to all banks eventually when they adopt CECL. So this sort of extended giving them an additional extension of relief of the impact of CECL on capital. Okay, Part 363. Everybody's pretty much aware of these triggers, and so the over 500 and the 1 billion triggers are significant. It's a big deal, and so people keep an eye out for those, and they should. And of course, the PPP loans increase everybody's average assets, and the next slide will discuss the relief that was provided. But before I get into that, did want to highlight that the independence rules here, this middle bullet point here, we've seen that catch a lot of people here because it sneaks up on people. So since we have to be independent, obviously as auditors, we cannot prepare the financial statements, and because their SEC independence rules are much stricter than the non-SEC independence rules. And so we can't prepare the financial statements. We can't help with the income tax provisions. I don't think we can keep tax depreciation schedules. We can't house those on our system. And so, there's various things that might trigger a lack of independence. And so the tricky part here is that most firms, and certainly Eide Bailly, is interpreting that as starting with the comparative year. And I think the FDIC theoretically looks at it that way too. And so you really have to, and that was sort of before the relief came in on this trigger, that was really a concern for 2021, because we'd had asset growth here in 2020, and you would have had to have, if you tripped the wire, then the comparative year in 2021 would have been 2020. And so you can't shift these items to bank preparation early enough, is basically what I'm saying. Is that you just don't want to get in a position where you have to change firms because you have a lack of independence. And so we're more and more shifting this as soon as we can. As soon as that 500 million comes into even close, we're starting to shift this as early as we can, because you really don't know when you're going to trip the wire. And let's go to the next slide, because that is where the relief is. So this got issued on 10/20/20. And it is nice relief because it basically suspends, the triggers, and it goes back to the asset size of 12/31/19 for all banks. And so, the FIL mentioned that there was about 290 institutions affected, and this was great news for the banking industry, because it really deferred some compliance costs here. It's effective immediately. There's this notion that if you have a consolidated situation and you're filing an FRY6 with the FRB and you're over 500 million in assets, that there is still the audit requirement out there. Now, I know this was a question in the earlier session, and they did indicate that they're looking at it. So this may change. They're aware of it, but they haven't come up with anything official. So just be aware that this could change. And if you're a holding company, you may not get the relief that's intended here. I also want to point out that there's this. They reserve the authority to require compliance with Part 63 if growth was related to merger or acquisition. And so no indication as to how they're going to interpret that. I in particular have a client that was right in the crosshairs of this thing. I think they were 800 million at 12/31, and they acquired a bank that was 250 million at 12/31, and that merger closed on 5/31. And so I'm expecting that because the combined asset size at 12/31/19 was over $1 billion, that they will be required to implement the over 1 billion, internal control audit for 2021, that they won't get relief, but I don't know that for sure. I think that's just going to be a fact and circumstance. They just reserve the right, and there's no guidance as to how they're going to be applying that. I wanted to talk a little bit about the Main Street Lending Program, which doesn't get a lot of attention, but it is one of the tools, being used by the government to assist with the pandemic and the subsidy. So I think you probably know what it's designed for, and there's a $600 billion max that was authorized by Congress, but only $3.7 billion has been issued through 10/30. So a lot of capacity left. I think it's supposed to expire at the end of the year, but I think it'll probably be extended because it's got a lot of room left. They're trying to make it more attractive. And I've got this graphic on the right side here, which shows the minimum loan size started out at $1 million originally, and they made 3 reductions in that minimum loan size, with the most recent being just last week, where they dropped it to $100,000. And so they're trying to make it more accessible to industries out there. So generally speaking, that it's kind of like an SBA loan, but there's no guarantee and there's no forgiveness. It's a 95-5 split with the bank keeping 5%, and so they would have 5% skin in the game when it comes to credit losses. So banks are being careful as far as getting involved here. The repayment structure is listed there. It's a couple of years, I think, where it's I think the first year interest is capitalized. There's no interest payments for there's no payments at all for the first 2 years, with the first year being interest capitalized, and then principal repayment kind of back-ended to 70% at the end. Interest rate is pretty much a market rate. There is a 1% loan fee, which with the 95% sale basically ends up being gain on sale income for the most part. Now, I put in red here that they just last week, to make it more attractive, increased that to 2% for loans below $250,000. So the Fed Reserve has a lot of flexibility on this. This is just a program that they're running. I don't think there's a lot of boundaries as far as rules, and so I think they're bending the rules they made themselves to make it a more popular program. And so maybe it's something, if you haven't looked at doing, maybe it's something that's you should relook at it perhaps. There's a servicing there's a servicing fee of 25 basis points also that's paid. So I give an example here in case you want to go through it, but it's basically similar to an SBA loan sale. The client that I have that's doing this is not recording a servicing asset or liability. They're assuming that the cost of service equals the 25 basis point servicing fee. I won't go into the details on this example, but you can refer to it if you are interested down the road. I did want to throw up, this is public information, and so I just pulled the California banks that, I guess this was as of 9/30, there was $84 million. And these are all the banks in California. So there's only 6 banks in California that have participated in this program. I have one of those banks as a client, and in talking to the credit admin person who runs this thing, they've seen it as a really good opportunity to pick up new loan and deposit relationships, because there's not a lot of banks doing this. There's a bit of a supply and demand sort of thing here, to where they can be pretty selective about the borrowers that they lend to here. They can only take the best. And so the other thing is here too, that you can refi other bank debt entirely, but if it's your own bank debt, you can only incrementally lend under this program. And so where the bigger dollars are is to basically take another bank's debt and refi that entirely under these more favorable terms. And so they view it as an opportunity, and they picked up some really great loan relationships. And so it is a way to do that. So you may want to consider the Main Street Lending Program. Okay, so we're going to get into the adoption of CECL here, since we have a couple clients that are in CECL adoption mode for this year. You can see the dates here, the ASUs, the change, the effective date, which everybody is pretty much aware of. It's 1/1/2023 for everybody except for the large accelerated SEC filers. The CARES Act did provide the option to delay the 1/1/20 effective date for those large SEC filers. And I guess out of our 5 SEC filers, I think 1 took advantage of that. And I guess there was only 2 banks that were large SEC filers that we have. And so 1 took advantage, 1 did not. Some adoption takeaways. It was kind of funny that not funny, but it's just interesting that the adoption date was 1/1/20 and they missed the COVID-19 impact. And so at 3/31, they had to, ramp up through their earnings and through provision to cover the effect of COVID-19. So this transition from PCI to PCD, we've had a little bit of work in that area, and it's a pretty straightforward process. I'm not going to get into the details because it's pretty nuanced and technical. I will say that all the discussions that we've had on people that are adopting, that no one is using the WARM method. The bigger banks are using the more sophisticated software, and I think the WARM method is really intended for the smaller community banks, and I think that continues to be the case. A lot of software being developed in that area that is being catered to the smaller community banks. And every time we have a FASB regulator or a regulator talk about small community banks or community banks adopting CECL eventually, that they really focus on this WARM method. So, and it makes sense. The WARM method uses a historical loss rate that is the same as the existing, incurred loss model. And so you can operate, using that same metric that we're all comfortable with. getting an annual loss rate, but then just pushing it forward over the remaining life. And so that I expect once the community banks start coming into adopting this, that the WARM method will be by far the biggest method that's used. I've got this note here that early adoption at 1/1/21. I do have a client that's doing that. It's my SEC client who has decided they're going to adopt CECL early. And again, this conference I was at yesterday, there was another bank that adopted early. And so I think that it's a very small population of banks that are considering or that have adopted early. The notion of adopting early for the one client that I have, and I guess their TIB is an entity out there that's kind of pushing it, I guess. But the thought is that with the COVID-19 effect starting to kick in and really in 2021, there's a pretty good sized number that you could record that would go through retained earnings at 1/1/21 by doing a life alone CECL calculation. And that would create earnings tailwinds for you after that point. And so it's strictly like a legal earnings management type approach that they've decided to adopt. And so we'll be working with them obviously to do that. So I guess it's something that if you thought, that you could, if you needed earnings tailwinds, down, post 2020, then perhaps this might be for you.
Hey, Kent, we have a question. We have a Q&A with regard to one of your slides a few slides ago. But what the question is, you've talked about banks passing the 500 million level. Can you talk a little bit about when a bank passes the $1 billion level?
I'll let you answer that, Aaron.
Well, the primary change is you will then be required to have an ICFR opinion, an opinion over your internal controls over financial reporting. So that's that's the biggest change, is once a bank gets to that $1 billion asset size, you will have to undergo an integrated audit where we will then test internal controls. And so it is important, even though we've gotten that slight break from with the 1020 relief, that if you are getting ready to approach that $1 billion mark, it is important to get your controls, your internal controls documented, implemented correctly, and hopefully maybe do a test of operating effectiveness prior to your $1 billion triggering event. So that is the primary difference. Hopefully I answered that correctly.
Yeah, I think amplifying that a little bit more, because we view that as a really big threshold, right, for our clients, because they can't rely on the work that we do for our opinion. And so it's almost a parallel effort where you either have to do documentation because you have to provide a certification, the bank does, apart from our work that we do to justify the internal control opinion. And the opinion is as of the end of the year, by the way, which I think is an important distinction. It's not throughout the entire year. So a lot of times we do testing in the early part of the year to make sure that we can get to a clean opinion at the end of the year, right, Aaron? That's a fair statement, right? So the remediation process.
Yes.
So, it's a pretty significant effort. I don't know, Aaron, we've been through this a lot. A lot of our banks are outsourcing the documentation that the bank is required to generate in order to support their certification that they have to make as part of the Part 363 when they reach over $1 billion.
Correct. The internal controls and the documentation that's required is pretty burdensome. So I think most of our banks that are approaching that $1 billion mark and getting ready, they are outsourcing to other audit firms in preparation. So yeah, it's very burdensome process, but the takeaway that I want to leave with you is be prepared, get ready early. Don't wait until that $1 billion mark, that trigger event, to get your documentation in place.
Aren't most banks doing it at least the year before, the later in the year perhaps, and then maybe they're doing a test run, and so they don't necessarily want to ramp up entirely in the year that it's first required. Right. It's usually the year before because they can see it coming typically. It looks like maybe we got a question or a chat asking who do we recommend, and what have we seen for firms that provide that service? I I know we wouldn't necessarily recommend any particular firm, but what types of firms? I think we've seen other CPA firms typically.
Yep. Depending on your location, you might have your smaller, more local firms. Like we have one here in California that is pretty prevalent in our community banks in California that does a lot of their internal audits. So they can be hired. Also, you can go find other audit firms. Obviously, Eide Bailly can't do it for you. We can't audit our own work. So, but yes, pretty much any of the bigger audit firms are, have the same processes that they can do this work for you as well.
And we try to collaborate with whoever they pick to where we can maybe do joint walkthroughs. So it's not, because if you got essentially a parallel process, but you don't want to necessarily be that inefficient about it. So we try and piggyback off of, when that other firm, the internal firm, does the walkthroughs, we try and piggyback on that. We instead of doing our own just separate testing, we try to make sure that they're testing the same controls, that the tests we can rely upon, so that we can just retest their tests, things like that. So there is a pretty collaborative relationship between us, the bank, and the outsourced provider of the bank's documentation of the control system, right, Erin?
Correct. And also, just to let you know, you do not have to outsource this. You can do it internally. We have several clients that have their own internal audit team that also does their control testing for them. So it's a decision that the bank can make.
Well, let's get back over to the agenda here and the adoption of the lease standard. You can see the effective dates here, and with the delays that came in, you can see the ASUs, there's a 1-year additional delay. And so for most calendar year financial institutions, you're going to be initially recording and disclosing as of 12/31/22. Now, for all accounting standards, there's this beginning of the accounting period notion but there's no cumulative effect on this. It's a balance sheet only. There's no income statement effect on adopting the lease standard. So as of 1/1/2022, there'd be nothing to record through retained earnings typically. And so, and then this is not effective for interim periods in 2022. And it's for interim periods after 2022. And so there'd be no quarterly impact for your call reports. And so you'd really just be recording the ROU asset and the lease liability at the end of the year 2022 as it currently stands. So it's moved around quite a bit. So it's hard to keep focused as to when exactly you have to adopt this thing. We've had quite a few banks that are public business entities. And so we've had some takeaways as to some things that are just unusual. And one of the things is you recognize the new lease at commencement date, which is the date available for use. That used to be, at least for for disclosure purposes, we used to disclose the minimum lease payments and the financial statements. That used to be the contractual agreement date under ASC 840. Now we're under 842. But interestingly, you recognize the impact of the extension extension or renewal as of the contractual agreement date. So just a little bit of a contrast there and slight change there. And then impairment, we've had some banks where they have some property that they're paying a higher market rate than what they can sublease it for because they want out of the space. And so that sets up for a potential impairment loss, which that impairment is now measured under ASC 360. It used to be under ASC 420, disposal activities. And so there's a potential acceleration. We've seen this in one of our clients where normally you would wait to record that with the ceased use date under 420, but now it's when you commit to a plan under ASC 360. So just something to be aware of. It's probably a rare circumstance that you would have that, but just something to be aware of. A couple of SEC items here. Guide 3 was updated. I think most people are aware of that just recently. It's been a long time since that thing has been updated, and it would affect the MD&A content for other filings, 10Qs, 10Ks. We don't anticipate, or we haven't seen any banks early adopt this thing. It's going to be effective for years ending on or after 12/15/21. We don't see anybody early adopting this thing because they're pretty comfortable with what they've got currently in their documents. The PCAOB issued audit standard 2501 effective for this calendar year, which gets into the reliance on the use of a specialist. And so Erin's kind of an expert in this area, so I'm going to let her talk about what the impact would be on internal controls for those where it would apply.
Yeah, so AS 2501, which is effective for this year for our public filers. while this is an audit standard, it actually has an indirect impact on management because it's going to require increased auditor scrutiny of your accounting estimates and fair value measurements, as well as the use of specialists. So from an impact on management standpoint, we'll be looking for increased documentation of your accounting estimates, the data, the inputs, and the assumptions being used in those estimates and fair value measurements. And then where management might use a specialist, we need to gain an understanding of your due diligence process of the specialist. So there is some increased work that's coming ahead due to this standard. And in addition, auditors will be looking at the management's controls over accounting estimates and fair value measurements.
And then it looks like we're running a little bit late on our agenda items. So I think I'm going to skip the COVID-19 impact on internal controls, but those are fairly obvious. I think you need to be looking at those if you're a public company. So let's move on here to the next area. Just some miscellaneous accounting items that I wanted to throw out there. It's some new disclosure items in the 2020 financial statements. The CBLR, when you've elected it, would certainly be different than what you've got currently. The 4013 election and the impact of 4013. Accounting for sub debt, there's a lot of sub debt that's being issued because of the low rates out there, and banks are fairly comfortable investing essentially in other banks. And there's this issue of whether or not it's a debt security or whether it's a loan classification. A lot of them have CUSIP numbers, but most people that I'm seeing are recording them as loans because there's not an active market and so it doesn't meet the definition under this handbook. And so this is one client who found this somewhat obscure reference. It's kind of old, but in checking with the OCC, it's still pertinent. And they decided to record it as a loan based on this guidance. And so whichever way you go, I think you can probably justify either one, but you probably would want to have an accounting memo to support your decision. Also, I wanted to highlight this vendor incentives in data service bureau contracts. They're fairly common at this point, and they can be pretty large at this point. And so we have seen where if there's a clawback feature on the vendor credit, if it terminates, if you early terminate the contract and you have to pay back a portion of the vendor credit that was given, then you can't record that on a cash basis if you're applying the credit to like just monthly amounts that are due. You have to basically disconnect the cash realization of the credit versus the accounting recognition. And so I've seen that be a material item, and it's kind of common at this point. So if you've recently negotiated a contract, be aware of that particular issue. All right, so I think we've wrapped up our presentation, and I'm going to toss it over to Bettina for the tax presentation. You see our contact information there. Let me see. Yeah. So I would say, particularly the disclosure, if you want example disclosures on the CBLR or maybe the section 4013, you could email me and I could give you, from my SEC client who's already done that for their 10Q process, I would offer that up. And all right, so I see Bettina has turned her video on, is smiling at us. I know she loves doing these presentations, but not really.
Absolutely.
But you're going to have to do this. Okay.
Well, I like talking about tax. It's standing in front of the camera. Not my favorite thing. As Kent indicated, my name is Bettina Brown. I'm a senior tax manager in the Sacramento office, and I work with our bank tax team in both the Laguna Hills office and the Rancho Cucamonga offices. And hopefully today I can give you some helpful information about taxes in 2020, because I think everybody can agree this year has not been normal. And the amount of tax legislation that has come out this year, also not normal. So this year we've had just tons of legislation related to COVID relief, both for individuals and businesses. So I want to start on some of the tax provision in the CARES Act that were designed to help businesses. Now these include PPP loans, specifically the PPP loan forgiveness and the PPP loan fees, changes to qualified leasehold improvements, excess business losses, and changes to net operating losses. So not a big surprise that there seems to be a disconnect between Congress and the IRS, because Congress specifically indicated that the debt forgiveness from the PPP loans would be excluded from gross taxable income. Well, the IRS responded to this with Code Section 265A1 that specifically disallows a deduction to the extent that the funds from a PPP loan were used to pay these expenses. Well, you can figure it out. This effectively makes the PPP loan forgiveness taxable. If you don't tax the income, but you disallow the deduction, you're pretty much taxing the income. So there are still some unanswered questions when it regards to PPP loans and how this is going to work. The disallowed expenses, how is it going to affect the wages for the 199A calculations? If the loan is forgiven in 2021, but the expenses were incurred and previously deducted in 2020, what year will the expenses be disallowed when and if the loan is forgiven? So right now, there seems to be momentum to get the PPP loans fixed and to get answers from everybody except Congress. Although I did hear, I think Mitch McConnell this morning saying that, yeah, we're gonna get back in on and start helping the economy. So fingers crossed, everybody, that something will shake up on this and we will have some more answers shortly. Next, I want to look at the PPP loan fees, because with the PPP loans come loan fees that came to most of our banks. Now, ASC 31020 or FAS 91, as I typically think of it, it governs the GAAP treatment of these fees that are received on the loans. For GAAP purposes, most of our banks are going to be recognizing the PPP fees over the life of the loan. But what about tax? Well, for tax purposes, the IRS has specific rules on what is going to be recognized for tax over the life of the loan and what is going to be recognized when received. So for tax purposes, only fees treated as points, OID, interest income can be recognized over the life of the loan. And fees that are treated as a fee for service or a processing fee are recognized for tax purposes when actually received. Now, the SBA refers to these PPP loan fees as processing fees, and it is meant to reimburse the bank for administering the PPP program. Therefore, fee taxable when received. But if you actually look at the substance of the transaction, the fees are based on the principal of the loan. They're used for the use and the forbearance of the money. It's considered to be paid by the borrower, even though it's actually paid by the SBA. So therefore, it looks like interest income, OID, taxed over the life of the loan. So you can argue characteristics for the treatment either way, tax now or tax over the life of the loan. We actually might be working with our banks to see what is a more beneficial position. Are we thinking tax rates are going to rise in the future? Do we think they're going to stay the same? The Democrats are going to control the House. The Republicans are going to continue to control the Senate. So any kind of change by either President Trump or President Biden, whoever wins the election, is going to be hampered by this. So any changes that we see might not happen right away, but this is something we're going to have to keep our eye on to see how these fees are actually going to be treated. So one of the other provisions of the CARES Act had some special rules for retirement funds. Now, I've had several banks contact me regarding these changes or relaxing of the rules because the bank holds IRA accounts for customers and they administer and prepare the 1099 forms for these accounts. So if your bank holds customer IRA accounts, please note that it's easier to withdraw funds. Some of the tax penalties on early withdrawals have been eliminated and rules on loans have been relaxed. And my most frequently asked questions, yes, there has been a temporary waiver of the 2020 minimum distribution rules. Now, some other changes are charitable contributions, both for individuals and corporations. Individuals will enjoy a $300 above the line deduction, and the 60% limitation has been suspended for 2020. Corporations will see a rise in the deduction from the 10% of taxable income to 25% of taxable income, but this change is only for 2020. Now, there have also been some changes in the net operating losses that allow a 5-year carryback for NOLs that occur in 2018, 19, or 20. I'm going to review these in a little bit more detail in a couple more slides. So excess business losses didn't have an effect on corporate taxpayers, but it does have an effect on our S-Corps and our pass-through entities. The Tax Cut and Jobs Act passed at the end of 2017, or the TCJA, put limitations on the deductibility of losses from pass-through entities. However, the CARES Act removed these limitations for 2018, 2019, and 2020. So for 2018 and 2019, tax returns can now be amended to reflect the removal of these limitations, and you can take a deduction for the suspended losses. Now, another provision of the CARES Act included a possible deferral of employer share of payroll taxes. The deferred employer payroll taxes are paid back over 2 years, half by 12/31/2021 and the remaining half by 12/31/2022. Now, although the remittance of these funds to the IRS can be deferred, the expense still needs to be recorded on the income statement with the payable recorded on the balance sheet. So the actual benefit to a bank is not going to be that significant. Now, although the deferred payroll taxes are generally not deductible until paid, there is a possibility that the amount of the payroll taxes remitted by 9/15/2021 could be deducted on the 2020 tax return. So if your bank wants to defer the remittance of the employer payroll taxes, but wants to take a 2020 tax deduction, keep this date in mind. As with other items discussed today, the deduction decisions are going to be based on what we think the environment looks like. Are rates going to increase? Are they going to decrease? What is a good year for me to pick up this income? What's a good year for me to pick up this deduction? So that'll all come into play. Now, another change caused by the TCJA was a limitation of the company's interest expense, 163J. The limitation was at 30%, but the CARES Act increased the limitation from 30% to 50%. So also included in the CARES Act is an acceleration of the refundable alternative minimum tax credits. The Tax Credits and Jobs Act had made earlier changes to AMT credits, allowing credits not offset by current taxes to be refundable at a rate of 50% per year through 2021. The CARES Act speeded this up, and instead of the full balance of unused credits being 100% refundable in 2021, the full balance of unused AMT credits are 100% refundable in tax years beginning in 2018 and 2019. Now, this change can help banks not only obtain the refund, but also with their capital ratios, because tax credit carry forward deferred tax assets are not included in your Tier 1 capital ratios. But if the amount that used to be an AMT tax credit carry forward is now a fully refundable tax receivable, it can now be classified as a current tax receivable, and it's not going to be excluded from your Tier 1 capital ratios. So moving on to our net operating losses, or NOLs. So the Tax Cut and Jobs Act made the NOLs for tax years ending after 2017 not available for carryback. So they could only be carried forward for anything after 2017. And any NOLs after 2017 are only 80% offset of taxable income. But the CARES Act also made some modifications to these rules. The TCJA tax changes will not be implemented until tax years beginning after 12/31/2020 instead of after 12/31/17. And for tax years 2018, 2019, and 2020, NOLs can be carried back 5 years. Now, NOLs from 2018, 19, and 20 can offset 100% of taxable income, but only through 2021. In tax years beginning in 2021, it goes back to NOLs from those tax years can only offset 80% of taxable income. So what does this mean for tax losses in 2018, 19, and 20? Well, it means if there was a tax loss in any of these 3 years, you must carry the NOL back, or you must make an election to forego the carryback. The carryback must be carried back the full 5 years to the earliest year with taxable income. Now, due to differing tax rates in the 5-year carryback period, it could be advantageous to carry back a 2018, 19, or 20 tax loss to a prior tax year instead of carrying it forward. This is because in the prior years, the tax corporate rate was 35%. So here's an example with a 2019 NOL of $1 million. Now, yes, I realize the slide says $1 billion, but I'm happy to report that I've not had any bank lose $1 billion. So I decided that we're going to take the amounts down just a notch. So at a 35% tax rate, the $1 million tax loss carried back would result in a refund of $350,000. If the tax loss is carried forward at a 21% rate, the potential future tax savings is only $210,000. So in this example, by carrying it back, you're going to result in $140,000 more in tax savings than if you carried it forward. Now, as with the AMT credit carrying back, the NOL to obtain a refund should have a positive effect on your Tier 1 capital. Your net operating loss deferred tax asset is also excluded from your Tier 1 capital when you do your ratios. But if these NOL carrybacks now turn into a receivable, you can classify them as a current tax receivable, and it's not going to be excluded from your Tier 1 capital ratios. All right, qualified improvement property. So what is qualified improvement property? Now, leasehold improvements to the interior of branches or offices may meet the qualifications to be treated as 15-year property. The leased building must be at least 3 years old. There can be no relationship between the bank and the owners of the building. The improvements cannot be to an elevator or escalator or move internal structural framework. The IRS actually created the 15-year qualified leasehold improvement fixed asset classification several years ago. But when the TCJA was signed in late 2017, the 15-year qualified leasehold improvement designation was inadvertently missed and not designated. Now, this was unfortunate because the 15-year qualified improvement property area could claim the Section 179 deduction, and it could take the federal bonus. Now, the good news is that the CARES Act corrected this language to fix the prior admission, thus reinstating the 15-year qualified improvement property class that is available for both Section 179 and federal bonus depreciation. Now, the correction was retroactive to qualified property placed in service after December 31st, 2017. Now, please note that in order to have this 15-year qualified improvement classification, you have to be the one that makes the improvement. So if you purchase a building which includes leasehold improvements, they're going to have a 39-year life and not a 15-year life because you didn't make the improvement. The prior owner made the actual improvements. Now, as I indicated, the 15-year qualified leasehold improvement class can claim both 179 deduction and the federal bonus depreciation. Now, this is going to help not only our C Corps, but our S Corps. Although S Corps do not typically claim a Section 179 deduction because not all of the shareholders are able to utilize the benefit, the federal bonus depreciation still falls under Section 168, so it has the same tax characteristics as regular depreciation, making it much more attractive to S Corp shareholders. And since the bonus depreciation is currently at 100%, you can pick up the deduction on your returns. Now, there are different options for claiming the tax benefit of the additional depreciation. And the IRS has issued a RevProc that outlined the process to comply with the legislative correction of the 15-year qualified improvement property. Now, an item to note is that when the 2018 returns and possibly the 2019 returns were prepared, there was no 15-year qualified leasehold improvement class. So any leasehold improvements on your 2018 return and possibly your 2019 return, depending on when it was filed, would have a 39-year life for your leasehold improvements with no Section 179 or no bonus depreciation. Since the change in legislation was retroactive to assets placed in service after 12/31/17, prior returns may now have an improper method. So if you have your improvements on 18 and 19, you need to address the fact that you now have an improper method and you need to figure out the best way to do it. One is that you can file an amended return to correct the life of your leasehold improvements to a 15-year life and either claim the federal bonus depreciation deduction or elect to forego the federal bonus depreciation. Now, depending on which years are affected by the tax year change, you can amend returns for either the 2018 or 2019 return to pick up this additional deduction. Now, another option is you can file an IRS Form 3115 to request an accounting method change. The accounting method change that is being requested is to correct and switch the qualified leasehold improvements from a 39-year life to a 15-year life, and either claim the bonus depreciation or elect to forgo it. Now, Form 3115 can be filed with the 2019 return to correct a 2020 tax year, or it can be filed with the 2020 tax return if you want to file and correct 2018 and 2019 or both. The Form 3115 is filed with the corporate tax return with a separate copy also mailed to the IRS. Now, the changes that I've mentioned are federal only, and so you really should check with your tax advisor to determine if your state follows federal 15-year fixed asset life or bonus depreciation rules. Okay, Next, employee retention credit. Trying to watch my time here. So I don't want to spend a ton of time on this because, as I will touch on later, there are some hurdles to overcome for a bank to claim this credit, but I've also been asked a ton of questions on this credit, so I don't want to not answer questions. Real quick, the credit is $5,000 per eligible employee. An employer is eligible for the credit if there is a full or partial suspension of the business due to a government order, or if there is a significant decline defined as 50% in gross receipts compared to the same quarter in 2019. So here's some general info on what is deemed as qualified wages. Qualified wages are going to max out at $10,000 per employee. There's a limit on the qualified wages for the employee, but there is no dollar limit on the overall credit that a business can claim. Now, the credit is going to be claimed on your quarterly 941 payroll report. Current payroll tax deposits can be reduced by the amount of the credit claimed. And effective 2020 Q2, the Form 941 was revised to include lines to report the various COVID-related payroll tax credits available. If the credit exceeds the amount of your calculated payroll deposit and you want your money now, you can file a 7200 to get an advance payment. Recent guidance was issued addressing what qualifies as full or partially suspended. Banks were specified as being essential businesses and not partially suspended. They did also issue guidance on addressing employee time for the time of the employees providing the service and not providing the service, but note that the requirement that an employee must be paid but not working only applies if you have 100 or more full-time employees. Otherwise, you don't need to worry about whether your employees were working or not working. There's also coordination with other COVID-related benefits that need to occur. Anybody that took a PPP loan, they can't take the employee retention credit. But in economic injury disaster loans, not going to affect your ability to claim the credit. Other payroll credits, such as the Employer's Payroll Tax Deferral, Families First Coronavirus Response Act credits, Work Opportunity Tax credits, paid family and medical leave credits. These are not going to eliminate the ability to claim the employee retention credit, but you have to coordinate the use of the credits to ensure that the tax credits and the qualified wages do not double dip. Now to the crux of the issue. To qualify, employers must be either fully or partially shut down or need to experience at least a 50% loss in gross receipts. Although some banks may have provided customers with payment delays, thus reducing receipts, the actual numbers would have to be calculated to see if the 50% threshold was actually met. Also, as essential businesses, most banks were not required by a governmental entity to actually shut down. If you voluntarily closed your lobby and just went to drive up or walk up, that actually doesn't meet the standard for this. Now, this doesn't mean that there is no chance for the credit. It just means that a decision will have to be determined based on a case-by-case basis, based on the facts of each situation. If additional guidance is issued that clarifies opportunities for essential businesses to claim the credit, we'll keep you posted on this. And now for our first non-COVID tax change of 2020. So the IRS has revised a previously retired Form 1099 NEC. The NEC stands for non-employee compensation. I need to close my polling window. There we go. Basically, this replaces Form 1099 MIS Box 7. You might recall that 1099 MIS Box 7 is probably the most used box reporting for this 1099 form. It's used to report payments to any vendors, directors, anything that was a payment for services that was required to be reported used to on Box 1099 MIS Box 7. Now, all of that reporting is going to be on Form 1099 NEC Box 1. Now, none of the reporting rules have changed. The only thing that has changed is the form and the box numbers. Payment over $600 are still going to be required to be reported. Corporations are exempt from reporting unless it's an attorney, etc. All of the rules are the same. No changes to the rules, just where reported. Now, in prior years, the IRS had one filing deadline for 1099 MIS forms with Box 7 and a different filing deadline for 1099 MIS forms not reporting amounts in Box 7. It was a little confusing and probably a bad idea. So now the IRS has gone back to two different forms. 1099 MIS is one form, 1099 NEC is the other form. 1099 MIS is now due to the IRS March 1st of 2021 if you're filing on paper, March 31st, 2021 if you're filing electronically. Form 1099 NEC is due to the IRS by February 1, 2021, regardless of whether you're filing on paper or electronically. Okay, now back to COVID, but just kind of, because 1099-C has been around a long time. But as you remember earlier, we reviewed that the SBA forgiveness of a PPP loan was not taxable. Well, if a PPP loan is forgiven by the SBA, the bank is not required to file a 1099-C to report the forgiveness of this debt. But if the borrower later defaults on part of the loan that was not forgiven by the SBA, then 1099-C reporting requirements will apply. One of the things that happened is when the president declared the disaster relief, it opened up the ability of some disaster relief IRS code sections. I had several questions come up about this back in March when the emergency declaration was declared, but just in case anybody missed the info, real quick, employers are permitted to reimburse employees reasonable and necessary expenses related to COVID and not include the reimbursement as taxable to the employee, but they're still permitted to deduct the reimbursed expense. There's a list there of some possible examples, and again, not reportable to the employee as wages, deductible to the employer. No substantiation is required as long as the expenses are in line with expectations. There's no dollar limit, no discrimination testing required, no formal plan required. But this is the IRS. So I have to tell you, having a plan written and spelled out is not a bad idea. If you are making payments that replace income, that will not qualify for this area. The other thing, the other disaster relief that came up was Section 165, and it allows a disaster loss to be reported and deducted on a prior year return. I don't know how many of this will actually apply to our banks. An example would be if due to the pandemic, a branch had to be permanently closed and leasehold improvements abandoned. Now the loss on the closure of the branch could be claimed on a 2019 amended return as opposed to waiting to take the deduction on the 2020 tax return when the branch is actually closed. Also, if you have any contracts canceled, any significant expenses for cleaning, sanitizing, anything like that, they can all be claimed on an amended 2019 return. I just want you to keep in mind that there is a cost of preparing an amended return. So you need to make sure that the expense is significant enough to warrant the additional preparation of a tax return based on the refund that you're going to be receiving now instead of later. I think last thing I'll hit upon is just the temporary relief to our S-Corp banks that allow the bank to pay a tax distribution to their shareholders, even if they fall into the Basel III capital buffer zone. The community bank leverage ratio relaxation is 8% for Q4 2020. It increases to 8.5% for 2021, and it is back at 9% for 2022. The rest of the slides kind of have some general information. To be honest, I did include some slides for non-accrual interest and loan forbearance, even though there have been no changes in this area, and I don't want you to think there are any changes. Given the current environment, just in case we're seeing an increase in non-accrual loans, TDRs, loan modifications, I thought a refresher course on the differences or the possible differences between book and tax might be helpful. Your tax person knows the tax rules, but you know your bank. So I'm hoping that I gave you enough information to ensure that you know when to call us and say, hey, I think this might apply to me. Can you check it out for me? The more we can be in communication about your bank and our knowledge, the easier we can help you in accurately preparing a return and, more importantly, helping with tax projections and tax planning to minimize your tax bill. So if there are any questions that you think of later, especially as you look at all of the slides that I didn't go through, the last slide has my email. Please feel free to email me anytime, give me a call. whatever works best for you. Everyone at Eide Bailly would like to help our clients be able to do their tax return and feel like it's not a form that you sign and put in the filing cabinet and hope that you never get asked a question on. Thank you so much for your time today. As I know you've heard, many times, I feel like a Southwest, captain saying, you have lots of CPA firms to choose from, and we thank you for choosing Eide Bailly. We hope that we are always able to exceed your expectations, and that we can clear up some of the confusion of accounting and taxes. So I'm going to turn it back over to whoever is wrapping us up today.
So thank you so much to all of our presenters. Thank you to all of our attendees. We really appreciate it. You guys have a fantastic day.